Hey, Kelly.
Hey,
What's up?
Sean.
Happy
Oh,
Thursday.
happy Thursday. Another beautiful day in North Carolina.
Yeah, absolutely. Okay, so today we're going to be covering the short-term rental loophole. This is something that we get frequent questions about. It's a strategy that's also leveraged a lot by real estate investors to offset non-passive income. We're going to wait a couple minutes to see if we have some late arrivals here. Of course, they can always catch up. We also record these sessions, so feel free to reach out to request a copy. We can also share it with people who have joined late so that they don't miss out on some of the core strategies that we're going to cover in this meeting. So 30 more seconds and we'll dive in. Okay, great. Let's get started. So Digby is a tax CPA firm focused on helping real estate investors better understand the taxes on their real estate investments, filing, and also we do planning as well. We host these real estate webinars on a regular basis to try to help investors better understand the opportunities that are available to them. So with that, let's dive in. Kelly's going to cover the agenda, what we're going to talk about today.
Absolutely. Thanks a lot, Sean. So today we're going to be talking about the short-term rental loophole. And from the IRS's point of view, what we have to do in order to qualify for it. So today we're going to talk about how we can save you a lot of money from a tax point of view. And we have a really good example just kind of going into that. We're going to talk about the requirements to use the short-term rental loophole. And that's going to be material participation requirements, and also some of the requirements on your property, such as how long it can be rented out. Then we're going to look at what expenses you can deduct from your taxes, and then how to accelerate depreciation to save even more at the end of the year. At the end, we're going to go over some of the common mistakes that we see, and then we have a live Q&A as well, so we can answer any of your specific questions.
Okay, thanks for that, Kelly. All right, I promise we're going to dive in and talk about the core tax strategies that you can leverage, and also give you a reason to continue listening to the requirements. We're going to do some quick intros, and then we'll dive in. So, as you know, I'm Sean O'Keefe. I'm a real estate CPA. I also invest in real estate myself and love helping real estate investors find opportunities to save money on taxes. Kelly?
My name's Kelly O'Keefe. I'm a real estate enrolled agent. I'm also a real estate investor, and I have two properties, one in North Carolina and one in Colorado.
Thanks, Kel. I should also say I have 10 years experience. I think I left that out. Maybe I didn't, but let's move on. All right. I have to read this disclaimer to you. Our lawyers ask us to read it. Once we're done, we're going to move directly on to the core of why you should continue with this strategy, with this presentation, and spend another 15 minutes with us understanding how this short-term rental loophole works. So 15 seconds on this, we'll dive in. So this presentation is provided for illustrative purposes only. It does not provide personalized tax, legal, financial, or other professional advice. Your situation may be different, and I think that is completely fair. Consult a professional for information concerning your individual taxes, financial, or legal situation before taking action. Now, finally, I'm going to point out we're going to answer questions at the end of this session. So if you have questions as they come up, feel free to drop them into the Q&A, and we'll select a few of those at the end of the webinar to answer. So let's talk about why you should care, right? So why should you spend another 15 minutes with us understanding how the short-term rental loophole works? So first of all, there are two ways that you can take advantage of the short-term rental loophole. One is what kind of rental property you have. The second is how much you participate in managing the property. So we're going to spend most of our time talking about this column here and this row here. And these are the advantages. So if you have a long-term rental with 30K in losses and 160K in expenses, that's 130K loss, right? And if you have non-passive income or W-2 income of 150K, 250K, that would make it so that you wouldn't be able to take advantage of these, of the losses to offset non-passive income, and your taxes would be 87,000. Let me reiterate why that is true. So with a long-term rental, the losses that you can take per year are limited to 25K per year. As soon as you make more than $150,000, you're not able to take any of those losses and offset non-passive income. They get carried forward into future tax years. Now, why is this called the short-term rental loophole? Like, so why do people keep saying that? Well, the only way we can explain that is to compare it to the long-term rental, right? So if the losses are capped at 25K per year on the long-term rental, and you can't have more than 150K, you'll notice here with the short-term rental that there is no 25K cap and there is no income limitation, right? And so that, as a result of that, you're able to take losses that you wouldn't normally be able to take with a long-term rental. So we're going to spend most of our time explaining how to leverage this strategy. And this second slide here is a great way for us to visualize how different the short-term rental loophole is versus having a long-term rental. So I already walked you through the long-term rental where you have $90,000 in taxable income, right? Or you have $90,000 in taxes here at a 35% tax bracket if you're making $250,000 a year. And then those losses, those passive losses that you have on the long-term rental, you can't use them to offset non-passive income. They just get carried forward into future tax years. With the short-term rental in the exact same situation, you would be able to use this 130K in losses to offset 250K in non-passive income. And then as a result of that, you'd only be paying taxes on 120K, the 24% tax bracket. So comparing these, the taxes paid between the short-term and long-term rental, that's about a 60K tax savings. So let me say that one more time for everyone who thinks that tax and tax strategy is super boring. That's a $60,000 tax savings if you have a short-term rental in the exact same situation versus a long-term rental. So now I'm going to hand it over to Kelly, who's going to walk you through how to qualify for this 60K tax savings that we just talked about, at a high level, how to qualify for this. So Kelly.
Awesome. Thanks a lot, Sean. So right now, let's take a look at this example again. So how do we go from that almost 90K in taxes that we'd have to pay, and then get that down to 30,000, essentially saving us $60,000. So there's a couple requirements that we're going to need to be able to meet. The first one is if you're filing, married filing jointly, you and your spouse, sorry about that, can materially participate or have active participation in that property. You also need to have at least a 10% ownership in that property, because if we don't have that 10% ownership, essentially any rental management company would be able to claim this short-term loophole. That property needs to be seen as more of a business, as opposed to kind of that second house that we see a lot in the tax world. There are some limits to how long guests can stay to make it a short-term rental as opposed to a long-term rental. And then the rental has to be placed in service before the end of the tax year. And we'll get into all of these in more detail. And this is still just a general overview, but we thought that would get you guys ready to kind of take in more of it. So now I'll pass it over to Sean again, and we can go ahead and talk about what qualifies as short-term rental and how that property has to meet those requirements.
Okay, great. So thanks for that, Kelly. High-level overview, how to qualify. I'm going to talk a bit more about the guests do not exceed the stay limit. So what does that mean exactly? What that means is if you have a short-term rental, unlike a long-term rental, people sign these leases that are, a year, 6 months, whatever it happens to be. With a short-term rental, the average stay of a guest cannot exceed 7 days. So they can stay for 1 day, they can stay for 15. But when you average out all the stays of your guests, it can't be more than 7. They also cannot stay for a period of more than 30 days throughout the year. That's kind of confusing because I just said 7. So what does that mean? Some people have these short-term rentals that are near a hospital. So you get the traveling nurses who keep coming back. So they come and stay for 15 days. They leave, they come back again. They stay for another 15. They leave, they come back. You can't have a guest staying for more than an average of 30 days. Otherwise, it's not a short-term rental. Finally, personal use cannot exceed 15 days or more. So this can happen where people own a short-term rental near a lake, near their, where they live, right? So they want to go up there and use the property. Makes a lot of sense. Use that property for your family. It can't be more than 15 days of personal use. Otherwise, you're no longer considered a short-term rental from the perspective of the IRS, and you can't take advantage of these, tax savings that we just talked about for short-term rentals. I'm now going to pass it over to Kelly, who's going to talk to us a bit more about what material participation means. So before I do that, I just want to remind you, we're talking about this row, short-term rental, and this column, material participation. So what does it mean to material participate? We just said what a short-term rental is. So now what does this column mean, material participation? Kelly.
All right. So traditionally, real estate investment properties are seen as passive investments, meaning we get a long-term rental, we put it on the market, we get a renter in it, we don't touch that property. So the short-term rental is actually kind of a loophole because it puts us into this position that sees our business is similar to being a hotel, whereas short-term, less than 7 days. And that's kind of where that 7-day rule comes from. So what we need to do is we need to be able to take that traditionally passive investment of real estate and actively participate and show that it's an active business. And the IRS has actually laid out 7 different ways to do that. We're going to look at 3 of them today. So we only need to meet one of these in order to qualify for the short-term rental loophole. So the first one is you participate in that property for more than 500 hours throughout the year. So once again, we only need to meet one. You participate substantially all of the activities. So all of the management, all of the renovations, all of the cleaning that's done on that property is being done by you. And the final one we're going to talk about tonight is you participate for more than 100 hours throughout the year. And that 100 hours is actually more than anybody else. So if we have a property manager that's going ahead and participating for 101 hours and putting that time into managing that property, we're not going to count. So we need to make sure that our hours are actually more than anybody else participating in that property and that investment. So next slide. All right, so some of the activities that count and that are going to get us to that 500 hours or that 100 hours. Cleaning and maintaining that property. So all of the time between guests that we have where we move into that property and we clean up, if there's a renovation project and the owner goes ahead and completes that themselves, that's going to count. The general activities such as booking, screening tenants, bringing them to the property, showing them around, 100% counts as well. All of the accounting and the record keeping that goes into those properties is also going to count. And then kind of like cleaning and maintaining the property, the landscaping, mowing the lawns, that upkeep is also going to count. So we've only included a couple of these, but if you want to see a more inclusive list, go over to digby.com and we have a blog post that goes into more detail. So you can scroll through and make sure you guys are meeting material participation. All right, so some of the red flags that the IRS is going to look for to show that you did not materially participate or that might be kind of skewing those hours, and this is coming straight from the IRS audit guide, is the taxpayer's permanent residence or they live hundreds of miles away from the rental. So let's say I have a rental property in New York and I currently live in San Diego. It's going to be really hard for me to be doing those day-to-day activities such as cleaning the property, screening tenants, showing them around. So that's going to be a red flag. It's not impossible to do, but the IRS is definitely going to look more closely at those properties that have it. Another one is going to be if there's a W-2 job that the property owner has that is very encompassing. So they're obviously working 40, 50, 60 hours a week in this property or in their W-2 job. It's going to be really hard for them to be able to put in significant time into that other one. And it's the same as if they have other time-consuming properties. That's going to limit their ability to participate. Another one, this is mostly day-to-day activities that are going to be able to substantiate that 100-hour requirement or the 500-hour requirement. And if you have a property manager that's doing the day-to-day activities for you, it's going to be really hard for you to meet that 100-hour or 500-hour requirement. So that's going to be another red flag for the IRS. Also, if the homeowner or the taxpayer is considered to be elderly or somehow disabled, it's going to be tough for them to complete those day-to-day activities. And that's something that they might look a little bit more closely at when they're scrutinizing those taxes. Another one, the majority of the hours that are performed for material participation doesn't impact the ability for that property to function. So these are something that we would call invested hours. And this is actually what we call the litmus test. So when we're looking at that property and we're trying to meet material participation requirements, one of the things we always ask is, if you weren't to perform this test, would the property still be able to run? If the answer is no, then that's probably not going to be something that we can put on our material participation time trackers, which we'll talk about in a little bit. So
Perfect.
on that,
Thanks for taking us through that, Kel. Yeah, I feel like understanding what the material participation requirements are and what hours count, pretty critical to claiming the short-term rental loophole. Thanks for walking us through it.
yeah, absolutely. So now we have a couple questions that were submitted in advance. We figured we'd put them in kind of in the middle, just so us talking at you guys doesn't get too boring, and we get to break it up a little bit. So the first one that we got to ask is, does the travel count towards material participation? Sean,
I can take this one. Yeah, so this is common. So like, especially if, say, for example, you are a short-term rental owner in California and you own a property in Tahoe, right? So Tahoe, for those of you who are not based on the West Coast, is 2-3 hours, from San Francisco. So if you had to drive up to your short-term rental to do some repairs or something like that, kind of count those, 2-3 hours of drive time. So 6 hours cumulatively back and forth. Can I count that toward material participation? The answer is no. You can't count that drive time. There are a couple situations where you can count drive time, but for the most part, we just say no. And if you need the drive time hours in order to qualify, then maybe you're not material participating, and you should revisit the litmus test. Okay, another one that was submitted in advance. So thanks for submitting these questions. Helpful to have them in advance so that we can prepare if we need to. So this one, Kelly. So does the time spent on this webinar or doing real estate education or research to go out and buy an investment property, does any of this time count toward material participation?
Yeah, and it's a great question. And one we see a lot. For the most part, we would call kind of the webinars and the education and the research piece investment hours. So we definitely agree that they're very important. However, the majority of the time, they're not going to count towards your timesheet and towards meeting that material participation requirement. One of the exceptions to this would be, let's say you're on Zillow or you're going in and signing a bunch of papers when you have purchased that property or you're in the process of it. If you have purchased a property, then those hours that you spent getting to that point would count. However, if you're just on Zillow browsing properties, looking for your next investment, that is something that wouldn't count.
Yeah, and so when you said investment hours to classify these things, I was like, oh, that sounds good, but actually that's bad.
Well,
okay.
Obviously investing, like, it's a great thing to do. Like, it's something you're investing in that property. It's going to run smoother. We think it's great. But the IRS is going to see it as, if you didn't go to that education course on how to be a better real estate professional, would you still be able to rent the property? And the answer is, yeah, probably.
Yeah. Going back to the litmus test, I think that makes sense. Okay, third question here. This question comes up a lot. If you're married filing jointly, you're trying to hit that 500-hour mark, you're trying to hit that 100-hour mark. Can you count the hours between, both people who are married filing joint? And so the short answer here is yes, you can. So if you do 250 hours, your spouse does 250 hours, can you combine those hours to meet the 500-hour requirement? Yes. Okay, Kelly, this question for you. This one is like a logical question. So I could see how maybe as a software engineer, submitted this question, because this is a very logical question when you're kind of reading through the material participation requirements. If you have 5 rental properties, how is it possible to participate in all of these properties, right? So like if I want to do 500 hours in each property, that's what is it, 2,500 hours across all of those? Sounds kind of impossible if I have a full-time job. So how does that work?
Right. And it's a great question. Obviously, the average human being isn't going to be able to participate for 2,500 hours a year. So the IRS has come out and said that if you have multiple properties, you can actually go ahead and group those together. So let's say you have, even less, we'll say 50 hours in one property, 10 in another property, 20 in another property, and then we'll say another 40 in one property. You could group all of those hours together, get you over that 100-hour threshold that we need to meet, and then still be able to claim material participation.
Yeah, so one thing I'll point out is this is complicated, right? So the grouping is something that is complicated. If you plan to group your properties to meet the material participation requirements, work with a real estate CPA to help you do this, not just because you want to make sure that you're grouping like-kinded, investment properties, but also if you sell one of them, grouping them also kind of impacts that decision. So short answer is yes, but consult a CPA or a real estate professional, a tax person before executing this grouping strategy. So, okay, perfect. Thanks, Gail. Okay, so we know that you're just covering real estate requirements from the IRS to meet the short-term rental loophole can be super boring. So we felt like having some example scenarios to just kind of walk through to add some context and color to these requirements might be helpful and a little less boring. So let me read these to you, Kelly, and you can answer them. So in the first situation here with Mary, they have a beach house that's been in the family for a few years. They go up there almost every weekend to use the property, but then occasionally they rent it out during the year. Would this qualify for the short-term rental loophole that we just chatted about, the requirements?
So the short answer is no, it's not going to count. Just because according to the IRS, they're going to see this as you having a second home or a vacation property that you're occupying. And then when you're not doing that, you're just renting it out for a little bit extra money. So 2 things that's going to happen here. One, they're going to go over the allotted number of days would be my guess. So over 15 days or over that 10% of the total days that's been rented. So they're not going to qualify.
Okay, perfect. Okay, next situation. We have John here, lives in New York, purchases a property in San Diego, uses it exclusively as an STR. There's a lot of distance there between New York and San Diego. And then, it looks like you have a property manager who's like managing the property on a day-to-day basis. But John also makes sure not to use it, for excess of 15 days. Does this property qualify as a STR or short-term rental?
So once again, the answer is going to be probably not. John's going to have a really hard time meeting the material participation requirement for this scenario. Reason being, he can't handle the day-to-day operations such as the cleaning and the landscaping when he's hundreds of miles away. That's why he's gone ahead and he's gotten a property manager. So unless he's doing something pretty extensive in those 7 days, such as a full property renovation, it's going to be really difficult for him to meet that minimum 100 hours, which would also have to be more than a property manager.
Okay, yeah, and so as Kelly already pointed out, these material participation requirements, you need to meet them every year. You need to meet one of these tests every year. The short-term rental, period of time that we talked about as well, that also has to be tested every year. So in John's situation, let's say maybe his hours in year 1 were to renovate the property. So he did go from New York to San Diego, rented the property, renovated the property for 3 months, got it ready, placed it in service. Maybe in that case, John could qualify. Would you agree, Kelly?
I would agree with that. I would be very careful with how he's tracking all of those and be able to substantiate that. We already pointed out that one of the red flags that the IRS is going to see is being hundreds of miles away. If that's the case and they're looking more closely at that property and at those tax losses that's being used to offset the W-2, then there is a good chance that he could get audited and he's going to have to substantiate what he did. But yes, entirely possible to do it if he did that full rent.
Right. And so that's the reason we're going to very, very briefly talk about tracking these hours a bit later in the webinar. But let's move on. So we talked a bit about the requirements to qualify for the short-term rental loophole, what the property needs to be like, how much you actively need to be participating. Now let's talk about these losses, right? We very quickly ran through this example at the beginning of the presentation. We said, hey, we have 130K in losses here, but where did these expenses come from, right? I have a short-term rental making 30K a year in revenue. How did I get 160K in expenses? And why would that be a good idea, right? We got into revenue or real estate to build passive wealth. Why would I want to lose $130,000 on my rental property? That doesn't, on the face of it, sound like a great idea. So let's talk a bit more about how this works. Okay, so these are all of the losses that qualify, or the majority of the expenses that are deductible on a rental property. All of these are cash basis. So that means that when these expenses are deducted from your bank account between January and December, you're going to deduct them on your tax return for that particular tax year. The only one that isn't cash basis, right? One that would be coming out of your bank account would be this depreciation expense, which I've bolded here. And so the reason why this is important is as we're thinking about these losses, right? If we had 130K loss and the majority of this was made up of depreciation, right? Which is technically not a cash expense. It accounts for the wear and tear on the building over time and on the assets that the rental owns. So how would this work into our strategy? Well, let's talk a bit more about what depreciation means, and how it works here in order to kind of think through how we could use this depreciation expense as part of our strategy to leverage the short-term rental loophole. So when you initially buy a property or, particular, you have an expense related to, say, for example, a renovation or something like that, an expense that would last for generally more than a year. So let's say, in contrast, you have a utility expense. So let's say you pay your electric bill. That's 1 month. After you pay the electric bill, you're not getting any more value out of that, particular utility expense after that 1 month. Versus a fridge, right? You go out, you buy a fridge, or you buy this investment property, that particular asset is going to last more than 1 year. So the IRS, really quickly, they assign a standard useful life to these things, these expenses that are, generally last more than a year. And for the investment property itself, long-term rentals have 27.5 years assigned to them, right? Short-term rentals have 39 years, and commercial properties also have 39 years useful life. AKA wear and tear, how long things take to wear out on the property. And that accounts for the depreciation. Now, there are some ways that we can leverage this depreciation, generate, huge losses, and leverage that, to offset our, our high W-2 income. One of those is to go out and get a cost segregation study, right? And these cost segregation studies basically break up the property into smaller pieces, right? So if we had 27.5 years, 39 years, it's going to take a very long time for us to depreciate something. And so a cost segregation study basically breaks up the property into smaller pieces, which more accurately reflect how long it's going to take to wear out. And as an example of this, let's say I buy an investment property for 800K, right? I would then, based on the IRS assigned useful life, divide that by 39 years after I subtract out the land value. You can't depreciate land, right? So land, is expected to last forever. So we would take this 700K, so we'd have 800K purchase price, subtract out 100K, we're left with $700,000. We'd then divide that over 39 years. And you're probably saying to me, after you crunch those numbers, that's not going to get us a very big number here, right? As far as like the expenses go. And as a result, not a very large passive loss either. And so the way that this works is you can go out and get a cost segregation study, which will basically break up the property into smaller pieces. So you buy this property and you can break out the fridge and the landscaping and all of these other smaller pieces of that particular property, and then put them on their own depreciation schedules, right? And so the IRS has said, if the asset has a useful life of 20 years or less, you'd then be able to get accelerated depreciation, right? So if you get a cost segregation study, break up the property into smaller pieces, the original value of depreciation assigned to these properties is not eligible for bonus depreciation, but the smaller pieces are. And as a result of that, if we didn't do a cost segregation study, an example I just talked about with 800K purchase price, 100K in land value, we would only have 18K in depreciation. We did a cost segregation study, but we didn't do any accelerated depreciation, bonus depreciation. We would have 30K, right, in year one for the depreciation. And again, 30K, we go back to our example here, 30K in depreciation isn't going to get us to the size of, losses or that would help us to get this kind of tax savings in year one. So, but if we did get a cost segregation study and then took the bonus depreciation on things with a useful life of 20 years or less, we might have $100,000 in bonus depreciation, right? And then in that case, that could be a significant enough loss for us for the situation to become more realistic. So if you have questions about bonus depreciation, cost segregation studies, we can go into that in a bit more detail. I think for this particular presentation, we didn't want to spend too much time on this. We want everyone to still be awake, by the end of the webinar, and also be able to get through, talking about this strategy end to end. And then this is a big piece of that, which we could do a whole entire, webinar on, and we probably actually will, provided we get enough requests for it. So I'm going to hand it over to Kelly, who's now going to talk about how to track the hours, right? So we did say tracking these hours is important. Understanding what hours, count, also important. So Kelly, just at a high level, walk us through how to track these hours. What does the IRS look for in the event that, John, in our previous example, I think the name of it was John, right? How would they substantiate their hours? How would they track them?
Yeah, absolutely. So I'm going to jump back to the cost segregation study. In our last webinar, I think we spent half an hour talking about cost segregations alone. So it is a pretty complex topic that we can talk for hours on. So if you do have questions, we'll happily do another webinar on it. We also have some great partners that do cost segregation studies that we're pretty confident in. So if you need those contacts, reach out to us. We're happy to put you in touch with them. But jumping back into it, so the IRS, when they're looking at those activity trackers, they're going to want to see a couple things. The first one is, what was the service that you performed? Was this cleaning the house? Was this landscaping duties? And with that, how long did it take? So realistically, we want to be as specific as we can and use examples such as calendars. If you have some sort of a ring camera that shows you coming in and out of the property, carrying a bunch of cleaning supplies, that's going to count as well. And then these records need to be contemporaneous. So what that means is the case that kind of pushed these out was somebody had created the record after that magically had them meeting exactly 100 or 500 hours. And the IRS actually ended up throwing it out of court just because they could clearly see that it was made after using the timestamps that were in Excel that they'd used to do it. So it needs to be from the time frame when the activity was actually completed. And if you do need to go back, it's more than okay to look at calendars and appointment books to really substantiate that. So one of the things that we've done at Digby, we created our own time tracker to try and make it as easy as possible for you guys, the investors. So all you're going to put is the property, the date it was completed, how long you spent completing the activity, a description of the activity that was performed, such as mowing the lawn, and then where or how this could be substantiated in the case of an audit. And we put as many drop downs in there as possible so that it's going to be accurate. So if you go back to our blog, this is available for free on Digby. Just click on the IRS time tracking. It's the one at the bottom left. Scroll down to the bottom. You can download this activity tracker, and it's entirely free. We've done our best to put as much work into it as possible so you don't have to. All right, okay. Next up, we're going to talk about some of the common mistakes we see at Digby or we've seen at Digby. So hopefully you guys don't fall into these traps as well.
Yeah, to point out, this stuff is boring, complicated, and so obviously people making mistakes. So the first one that we see is that people are not keeping, adequate records. This happens where everyone's busy. If you also have rental properties, pretty hard, to maintain, to spend time on it throughout the year. So at the end of the year, you're trying to hustle to create these records, whether it be time tracking or organizing all of your income and expenses. So it's something that I would suggest, setting a calendar time to do this throughout the year at specific times during the month, maybe once a month. Go in, make sure you're tracking all of this information, organizing your financials. Kelly, using the property, for too many personal days, give me an example of that. Like, when have we seen that?
So one of the ways that I saw it that was really tough to kind of see from the tax point of view is the individual had used the property. I think it was exactly 14 days. So they had 1 day on the end that they knew they were clear. But one of the things that they had also been doing is allowing their friends and family to come and use that property for free, with just like, hey, make sure you clean up after yourself when you leave. Not realizing that the IRS sees this as also a personal day. So any discounted rate that you give on that property for free or just less than the fair market value is going to be seen as a personal day to the IRS, and it's going to count against you at the end of the year. So that was one case that we saw that was pretty hard to stomach.
Okay, perfect. Yeah, this one's pretty self-explanatory, so we won't spend any time on it. Just not meeting the material participation requirements. So there are 7 tests. You need to meet one. You need to meet them every year. You need to meet these tests. Depreciation. This is actually an interesting one. At least if you're you're a tax accountant, maybe if you have a long-term rental and you convert it to a short-term rental, or you have a long-term rental, if you have a short-term rental, you're using the depreciation period for a long-term rental. We have a lot of clients that come to us from other, accountants who don't specialize in real estate, and you'll see them using 27.5 years instead of 39. This is not something that you want to do because you're taking more depreciation than you should. Finally, Kelly, do you want to talk to us a bit more about, this comes up all the time, constantly, Schedule C versus Schedule E?
Yeah, I'll pass this one back over to you, as like it's not something that I'm super great with. I know you're better with the forms than I am.
Yeah, so Schedule E versus Schedule C, so if you have a short-term rental, for some reason, if you have a real estate CPA, if you don't have a real estate CPA or someone who specializes in real estate, or you're just preparing your tax return on your own, for some reason, people want to put these short-term rentals on the Schedule C, right? Which is generally for like a sole prop or other types of businesses, not a rental. For a short-term rental, you're going to report that on Schedule E, unless, so this is a really important point, unless that short-term rental is performing substantial services, right? So you will report your short-term rental on a Schedule C only if it has substantial services. So that's things like concierge, like bed and breakfast, like you're cooking meals for these people like every day. Think motel, hotel, right? Not like classic Airbnb. So that's the only time you report this on a Schedule C. The reason why you should care about this, you're like, so what? It's on like a different tax form. No one cares. Actually, Schedule C, if you report income on the Schedule C, it's subject to self-employment taxes. Self-employment taxes, 15.3%. So this is a reason why you should care. 15.3% reasons to care about reporting it on a Schedule E versus Schedule C. Okay, great. Now, we're going to move, unless there's anything else on this topic, Cal, I think we can move on to just questions from the audience that have been submitted throughout the webinar. We do have a couple minutes here just to answer. I would say, let's just pick 2. We can kind of run through those. If there are some questions that we're not going to be able to get to, we will just send you an email, right, with the answer to your question. And hopefully we'll be able to get to all of them. If not, feel free to send us an email, and then we'll be happy to respond or set up a meeting to talk through those. So Kelly, I'm going to look at this question from Joe. Has a long-term rental, wants to convert it to a short-term rental, and is trying to understand if that, first of all, is that possible? Secondly, what are the big kind of things to think about as you're going through that process?
Yeah, so the short answer is it is absolutely possible to do. It can be a little bit complex. The biggest thing you're going to need to do is what's called a change of accounting method. And that's going to be filing a form 3115. And that's going to shift that over. Now with that, it can be a little bit complex. It's probably not something that I would recommend doing on your own. So if you are in that situation, that's where I'd reach out to your CPA, preferably one that's specialized in real estate, and they can kind of help you through that process and make sure you cross all your T's, dot all your I's. And if you need any help with that, feel free to reach out to us in the future.
Okay, yeah, 100% agree. It's not straightforward. It's not simple. There are some other things to consider, but on a procedural basis, the Form 3115, which is a 10-page form, needs to be completed. And so that's one of the big things that you need to think about as you're thinking about filing your return and converting this thing. There are some other questions like, is it a good idea from an investment perspective? Those are things to evaluate, not in this webinar, but something we'd be happy to talk about on a call. Okay, we have 30 seconds left. Kelly, give me rapid fire question. I'll answer it.
All right, so here's one we got. Our investor currently lives in Virginia. They have a rental property, it looks like, in Washington. So they have met material participation requirements in the past. What can they do to make sure that they're meeting material participation requirements in the future with that distance in between them?
Okay, yeah. So really quickly, things that we talked about before, which is and is in the IRS technical audit guide. So this is the guide that the IRS gives to their auditors to audit people who have investment properties, particularly short-term rentals. If you're not living within a few hours of the property, that's something that's really obvious to spot, right? On the Schedule E, your address, the address of the investment property is there. You look at your address, which is also included on the the Form 1040, and they'll be able to see that they're not close together. That's a pretty good indicator to the IRS. It's going to be tough for you to participate. So you need to make sure and track your hours. Make sure that you are the hours that you're actually participating qualify. You can use a tracker. You can use your own tracker, but yeah, just complete those hours. And then finally, if this is something where maybe you can't participate on a regular basis, but during that 1 year, right? So you need to do these tests every year. Maybe you did some renovations or something like that. It might be something that you'd be able to qualify for, but just generally for self-managing and being hundreds of miles away, it's tough to do. That's why it's a red flag to the IRS. So happy to chat more about this, and walk you through the hours, look through your tracker, provide some feedback one-on-one. But at a high level, it feels like there's a red flag there, something to be careful of. And unless there's some big one-off things that you've been doing that qualify to meet those hours, you probably don't qualify for material participation. Okay, great. That's it for all of the questions that we didn't get a chance to answer. As I said, we'll reach out by email, send you answers to those questions. If you don't receive an email, obviously feel free to reach out to us, and we'll try to answer them for you just over email. If it's a bigger question that would take a very long email to answer, that might be a reason that we don't send you a quick email to answer it. And so apologies if we didn't get to your question. Okay, that's it for us. Thanks for taking the time to join. We host these webinars on specific topics, at least a couple times a month. If you're interested in attending, feel free to reach out, and we'll send you a link to sign up. Anything else, Kel?
No, I think that about covered it. If you do have one of those longer questions that you're worried about, definitely book a session with us. We're happy to sit down, at least do a consultation with you guys, where we'll be able to better understand, and it'll also save us some back and forth on the emails.
100%. Yeah. And if you have ideas for webinars, things that you'd like us to cover, obviously also submit those ideas. Like I said, we do these, at least a few a month, and we always want to cater to do niche topics for the audience if there are any. All right. Have a great rest of your Thursday. Thanks for joining. See ya.